All right, my friends, so I was dealing with a lady yesterday as a client, and she had 3 different life insurance accounts. Well, 4. One was a term, but 3 were universal life. Now remember, universal life and whole life are 2 completely separate items, all right? So we're going to go into universal life here a little bit, and then when I'm done, she actually had an indexed universal life as well, which I'll dive into on the whiteboard when I get down the basement here later. Very nice lady, very smart as a whip, sharp as a whip. But I said, we need to get in-force illustrations on these. And like everybody, she didn't know what that was, so I told her it's no big deal. And frankly, her company, I think it was Equitable, got them to her quite quickly. I was quite pleased by that. Some of these companies take forever, man, and it ticks me off. I had a lady here in Georgia, it took like 2 months to get that crap. And then they didn't email it to her, they sent her like the hard copy. I was like, man, that's just the wrong answer. All right, so in this case, they got to her fast. I was quite pleased via an electronic copy, which he forwarded to me, which I was able to analyze. And it's good stuff here because we're able to look at it. So what an in-force illustration does is it projects the strength of your life insurance policy going forward. All right, your statement is a meaningless thing for life insurance. Your statement doesn't tell the story. It just says how much cash value you have in there and what your death benefit is and what you made last year. That's it. It doesn't say anything about the strength of the policy. So in this case, of the 3, and she's not paying any premiums, which kind of scared me a little bit. She had one with a pretty significant death benefit with not much cash value, which scared me quite a bit. She had one with a pretty significant cash value with a pretty high death benefit. I was like, ooh, let's see how that works. Turns out that was a keeper, absolutely. So of the 4 policies, one was a term, which she's not paying much for, so just keep that. No reason not to. I mean, literally, it wasn't expensive at all for a sizable death benefit. And the issue is, her husband will not die most likely before that term policy expires. I mean, the vast majority of term policies expire worthless. Very, very few actually pay out, which is why it's so cheap. And that's why insurance companies they underwrite you with like a fine-tooth comb because they want to know what risks they're taking on when they insure you. So inherently, they're not going to take on significant risk as it is. And so the only risk they're taking on is relatively stable and very stable health-wise people, and they're going to charge you a premium accordingly, and the vast majority of those premiums will just go into their pocket. It's literally all there is to it. It's a wonderful business to be in. You say, I'm not going to take that guy, thus I'm minimizing my risk. I will take this guy. My risk is jumped a little bit, but the likelihood of him dying is nil. So, and then if he gets in a car crash or something like that, I'll just sue the other insurance company, and this is what happens in lawsuits all the time. So if I have to pay the death benefit, if it's a car crash, we'll sue the other company for insuring a driver who killed my client, if that makes sense. So to recoup some of that fee. All right, either way though, they're not paying out the term likely because you're not going to die. All right, part 2 of this, though, she had the in-force illustrations, which showed that she had pretty significant issues on 2 of the policies because there wasn't enough cash in which to keep the policy active for very long. And so what we suggested was, look, you need to fund this other one. And I asked her to increase the premium from 0 to something and get a new in-force illustration that said what the premium with a $5,000 a year premium, what that will be on the contract, 5, 10, 15, 20 years from now. All right. And I don't know, it'd be interesting to see. So she's going to get that done and email that to me because I think that's incredibly important. And the other policy we'll get into here a little bit. We're not going to show you the policy, obviously. I'm just going to show you the what it has done over the last 20 years. Because an indexed universal life, there's a couple benefits of it. One is that you have a significant death benefit, leverage essentially. So if you die in a car crash, hubby in this case gets a huge amount of money, all right? And it's based on a premium that you put into. So you could talk in 20, 30 to 1 leverage. Now, as you get older, that leverage drops off because you have more and more cash value going in there. It's interesting. We'll go into that a little bit. But anyway, so that's one of the things that we're talking about there. So for her, that policy looked pretty stellar. But the drawback is, frankly, like last year when the S&P 500 was up, 32%, she only got 6% because that's a drawback. Morning. Hey, puppy. All right, but the benefit is in 2018 when the market was down 5, she didn't get down anything. That's the benefit of Index Universal Life. It guarantees you no loss, but unfortunately it gives you a ceiling of what you can get on the upside. So we'll run those numbers. I've done this before, but it's been a while, so we'll do it again because it does give you the experience from 20 years of the last 20 years, which you have negative, negative, negative to start the century, positive, 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 negative. You see what I'm saying? We'll go into that. It'll be interesting to see. Be it as it may. But you still have the significant death benefit attached to it, right? And as long as the policy stays funded with enough cash value to pay the increasing cost of insurance, once she dies, that policy will go to her heirs, be it her husband or her kids, tax-free, by the way. All right, pretty sweet. Now, there's a difference in Class A and Class B. Class A means you just have a death benefit. Your insurance, your cash value is included in that death benefit. So if you have $1 million life insurance death benefit or face amount, and you get $100,000 of cash value, your heirs will get $1 million, which means you're basically, your net at risk to the insurance company is $900,000, if that makes sense. You got $1 million death benefit, of which $100,000 is your own cash. The net at risk, the NAR to the life insurance company is $900,000. That's what they're insuring you for. If it's a Class B or option B, there's many different ways to look at this. You have $1 million death benefit plus the $100,000 cash value. So at your death, your heirs will get $1.1 million. The net at risk to the insurance company there is $1 million, and forever will be, because that will always be added to whatever cash value is in there. So inherently, because they have more risk, they're going to charge you a higher premium to make sure that policy is funded. All right. I'm more of a fan of Class A simply because it's cheaper. It keeps the premium down. But it does make your premium or your cash value, you're getting that via the death benefit. And a lot of people say, so I'm not getting my money back? Well, you are getting your money back. Without question, you're just getting less of an insurance, a life insurance component. But you're still getting $1 million. It won't grow. There's always going to be $1 million unless you get significant premium additions and you really get a significant cash value built up in there. But that's not likely to happen, especially in this case. Anyway, so we'll talk more about that. But the importance of understanding your life insurance, I cannot stress this enough. And I cannot tell you how many people don't get this. And I can't tell you how many people just say, I don't need to know. Oh, my goodness. If you don't know the difference between whole life and universal life, first and foremost, you're wrong if you have any of these policies. Both are called permanent policies. One's whole, one's universal, completely different things. Then you got option A, option B, then you got index universal life, you got variable universal life, you got all these different things. And a lot of people say, just buy term and invest the rest. Well, that's may or may not be. In this case, it's already a done deal, so we can't just buy term and invest the rest. She already has these policies issued, and she's 5 years older than what she was when she took them out. So don't just willy-nilly get rid of your life insurance just because some guy on YouTube says, universal life is evil, I tell you. That's just silly, man. What if you got rid of your universal life insurance and were able to pocket that $100,000 cash value and you can't get underwritten for term? Because I just told you what happens with term life insurance, that term insurance companies aren't in the business of underwriting risky people. Well, now you got no life insurance. So now you die. Your husband and your kids get $100,000. That's the wrong answer, man. You have no coverage. Don't do that. All right, we'll talk about it. We'll see you.